I'd like to invest there and maybe over there too. But how much do I invest in each place, and how do I put it all together into one whole? How do I build a portfolio that isn't just a bunch of random investments, but a well thought out system? One that grows with me, adapts to my life, and also serves my personal goals. That's exactly what we're talking about today, the logic of building a portfolio. I'm Valo Arume, and you're watching the Starfish Academy channel, where every week we share lessons on money, investing, and entrepreneurship. And if these topics resonate with you, then hit subscribe and make sure you're gaining new knowledge every week. What I started with, wanting to invest everywhere at once, is actually a typical mistake for a beginning investor, because with limited knowledge you should start with one asset class, master it, and only then look further. And once that's done, and you've been active for a long time, only then start thinking about diversification, because not all asset classes behave the same way. Each asset class moves differently depending on the economic cycle, inflation, interest rates, the geopolitical situation, and also the mood of the investors themselves. For example, if the stock market falls, perhaps due to fear of inflation or a military conflict, then at that moment bonds may remain stable or even rise, as investors move towards safer assets. If the real estate market is slow, for example due to rising interest rates making borrowing more expensive, then at the same time stocks may rise because companies are making strong profits or technology is advancing rapidly. If you have all your money in one basket, for example only in stocks, and that market drops 30%, then you drop along with it. Even if you know it will recover, the psychological blow can be so strong that you sell at the wrong time and lock in that loss. But if you have a diversified portfolio, one part may fall, but the other parts actually help keep you in balance. A single decline no longer means a catastrophe, it just means movement in another direction. It gives you a chance to breathe, evaluate, and continue rather than panicking and reacting impulsively. Diversification doesn't just reduce financial risk, it also reduces emotional risk, because investing isn't just a numbers game. It's also a game with your nerves, expectations, and also your patience. When you have a diversified portfolio, you don't look at the market every day with fear. You don't feel the need to constantly intervene. You don't panic if one part temporarily falls, because you know your portfolio isn't vulnerable to a single move or piece of news. And it also means that you can keep a clear plan. You can continue investing even during difficult times. The ability to continue even when others give up is what distinguishes mediocre results from outstanding ones. Diversification is not just a technical financial term. It is a protective shield that every serious investor needs. It allows you to create a system that stands the test of time, whether it's an economic crisis, a boom, or something in between. So when you think about building your portfolio for the long term, don't ask which single thing gives the best return. Instead, ask, how do I build a portfolio that helps me move forward calmly in every situation? This very question is what makes you an investor, not a speculator. But what does this mean in practice? Let's look at one simple and effective approach called the three-basket system. The first basket is liquidity, which is the money you'll need in the near future. This is your emergency fund or cash buffer. It covers your 3 to 6 months of living expenses, unexpected situations like job loss or major repairs. You don't invest this money for growth, you keep it safe and accessible, whether in a high-interest deposit, a money market fund, or just a wisely chosen savings account. The second basket is stability, meaning steady income and lower risk investments. This includes, for example, bond funds, dividend stocks, real estate funds, and liquid real estate ready for sale. This is your fortress, a place where you get passive income or where money retains its value without very large fluctuations. And the third basket is growth. This is where long-term yield growth happens. This includes, for example, broad-based index funds, stocks, startups, or riskier but potentially higher yielding assets. And this is the part that can fluctuate, but over time, it's exactly what grows your portfolio's value. And the younger you are or the longer your time horizon, the larger the portion that can be in this third basket. Let's take an example. Suppose you have 30,000 euros to invest. You could divide it like this. 6,000 euros in liquidity, meaning savings and a money market fund, 9,000 euros in stability, meaning bonds and dividend stocks, and 15,000 euros in growth, like index funds or some selected stocks. And such a distribution is not a rigid rule. It depends on your age, lifestyle, and actually your financial goals. In your 20s, you might have 80% in the growth basket because time is your ally. In your 50s, your stability share might be larger because you need more of a protective function for your money. But the most important thing is that a portfolio is not something you set once and just forget about. A portfolio grows, changes, and always moves with you. As your income increases, you add new layers. If you go on, I don't know, parental leave, then maybe you change your pace. As you approach retirement, maybe you change your focus entirely. For example, from growth more towards stability. The sooner you realize that your portfolio is a living organism, the more calmly and confidently you'll actually invest, because you'll know that you don't have to hit the bullseye every single time. To wrap up, here are 3 simple principles to keep in mind. First, start with a simple structure and just build on it over time. In the long run, diversify across asset classes unless you're just starting out, in which case it's definitely wise to focus on one asset class at first. And review it once a year, because life changes. Your portfolio needs to evolve right along with you. If this video gave you clarity and inspiration, then hit the like button and share it with someone who's just starting out on their investment journey.